My name is JC Simbana. I'm a vice president at Silicon Valley Bank. I cover the early stage healthcare practice for SVB here in the Bay Area. So what that means is I work with companies from raw startup that are literally forming all the way to when they raise their first round of venture round across all sectors. So everything from therapeutics to diagnostics, devices, and digital health. And I feel very lucky. I feel like I have a very unique and special job. And feel very fortunate to be in that position because it gives me an opportunity to work with a lot of entrepreneurs like yourself that are not only creating those innovative technologies that will become products in the future, but it also really is very invigorating to work with a cohort of people that are very enthusiastic about what you're doing, and it's really hard not to want to be around that because it's very infectious energy. So I do feel very lucky to have this role. And just a quick poll. How many of you in the audience have heard of Silicon Valley Bank before? The entrepreneurs. Okay, let's get it. It sounds like we're doing our job. So as Dan mentioned, so Silicon Valley Bank, we're actually a very specialized financial services firm. At the core, we are a commercial bank, so meaning we are the business bank for companies. We don't do any retail banking. We don't do any consumer banking. It's all focused on businesses, and more specifically on companies in the technology, healthcare, and clean tech space. Like I said, we work with companies from raw startup all the way to after they go public. And what we're probably best known for is being a debt provider, being a lender to venture-backed companies. And I'll explain a little bit about how that kind of ties into what we're talking about today in terms of fundraising. So you guys had some great panels today in terms of, I think that a lot of them touched on different aspects of fundraising, and a couple of points that I'll cover as well, and hopefully will be a consistent message and not be completely contradictory to some of the statements that were made earlier today. But here is kind of an overview in terms of when I think about companies and where they start from early stages to later stages and various different sources of capital. So as I mentioned, I work with a lot of early stage companies that are newly formed, sometimes spinning technology out of a university. And a lot of times that early money either comes from grants, government grants, SBIRs, SDTRs, friends and family money, funds that the entrepreneur has invested into that company. And in general, that tends to be the source of the primary capital from the beginning. Then transitioning over time as you gather data, as you gather maybe run some pilots at some hospitals or clinics, you begin to get some traction that begins to give you enough to go out and start raising outside capital from angels, and then eventually moving on to seed investors, venture capital, and then over time there are other ways to add capital to the business. But essentially, one of the things that we've seen really an explosion of over the last 5 years is an explosion of incubators and accelerators that are poised to help companies and early stage entrepreneurs find ways to connect with services, with mentors, with a network of people that are around this early stage innovation community. And here's just an example of some of the ones that we work with here locally. And they span everywhere from ones that are university related to others that have some sort of corporate tie, as well as foundations. But really, one of the strengths, I think one of the things to kind of consider, which you obviously have in applying to OneStart, is the value of what that incubator or that accelerator brings in terms of helping you get some funding, helping you connect into the network of people that are around this ecosystem, and really being able to kind of support your endeavor over time. So angels, I'm also, in addition to working for Silicon Valley Bank, I represent SVB on the board of Life Science Angels, which is a community of, it's a group of angels that come from industry that formally come together and invest in companies as a single entity. Like other angel groups, it's comprised of a number of individuals that are working together to help fund some of these companies. This is, in general, one of the things that I think distinguishes different angel groups from one another is what the makeup of that membership is. Sometimes it's capital that they're bringing to the table. Other times it's both capital and industry connections that, particularly at the early stages, can be very influential. And in general, the amount of funding that they provide can range anywhere from $200,000 at the low end up to $3 million. I've seen some syndicated angel deals at the $3 million mark with different groups kind of syndicating together, both on the West Coast and on the East Coast. Life Science Angels in particular, I think, did one about a year and a half ago. That was a $3 million syndicated deal. And if you look at a great resource is the Angel Capital Association website. You can see a lot of data there in terms of valuation trends that they're observing and have pulled from their members across different sectors. But one of the things that the Angel Capital Association is doing is actively trying to help syndicate some of these deals between different angel groups, because particularly if you're a therapeutics company or building a platform, the capital need the amount of capital that you need is sometimes outside the scope of what one particular angel group might be able to provide. But on a syndicated basis, collecting a number of these different angel groups together could be a way to raise some of that early capital that previously was done by early stage VCs. But certainly, kind of one thing I think this was mentioned before is keeping in mind the point of view from the angel standpoint of the incentives that those angel investors have, but also their ability to continue investing in your company as you need additional capital going forward. So sometimes there might be an inclination to look at an early exit from an angel-backed company because their ability to continue supporting their investment may not necessarily be able to carry into several $1 million worth of follow-on funding without getting themselves diluted. So sometimes, when you think about putting together your business plan in your Gantt chart, and you set up those milestones and timeline along a timeline of potential value creation milestones. Some of those early value creation milestones might be a potential early exit that would be relevant to an angel group, and something to kind of keep in mind as you're pitching that community of funders. Here I've listed a couple of angel groups that we work with here locally. Obviously, there are a vast number of angel groups across the U.S., and the Angel Capital Association website is a great resource to identify some local angel groups wherever your company is based. This is just some overall data in VC investment into life sciences, both from biopharma and device space. But more interestingly, I think something more interesting to look at than this chart is really, where are some of these investments going to in terms of indication, right? And I think these, if you want these slides, I'm sure they'll make them available. But this is just kind of an overview of some of the investments that went into these sectors in 2015. So depending on what area your product is focused on, good information to kind of have in terms of what's being funded, both on the biopharma side, but also on the device side. Additionally, and I think I remember hearing that there was about a quarter of you are digital health oriented, or there's digital health companies here that, obviously big trend that we've seen over the last 5 years, tremendous amount of capital that's going into digital health. The bar in digital health has certainly kind of climbed. A lot of the investors that I talked to that are looking at an early stage Series A, first institutional round of funding. Pilots are interesting, but it's really one of the big challenges that people have with the sector is it's a crowded space. There's a lot of competitors. There's a lot of people doing somewhat similar things. And the ability to get traction in the marketplace and do so in a quick manner, and flipping those free pilots into paid customers is really one of the primary challenges that we're seeing in the sector. But it's certainly not slowing down investment into the area. Now, I know there was one company that was from Albuquerque. Are you guys here? Oh, hello. So I actually grew up in New Mexico, and for me, one of the things that was really interesting when I first came out to the Bay Area was, growing up in New Mexico, you really didn't know much about venture capital. It was just kind of a strange sort of animal. Like, what is this thing? How does it work? And obviously, over the course, I think over the last couple of years, you've probably come to find out or come to learn about the mechanics and essentially kind of the structure of a venture fund and how it drives behavior. I think more importantly, and something to kind of consider. So, tying back to my question about poker. It's kind of funny. I've been playing poker for the last 8 years. Started playing as a networking sort of event. There was a VC poker circuit that got launched like 10 years ago, and I started playing just as a way to meet more and more VCs. And so now I host a quarterly poker game with a couple of VCs and a couple of entrepreneurs. Great way to socialize, and you'd be surprised at what you can find out about people when there's money on the table, and even if it's a small amount of money, certain behavior certainly kind of comes out. But it's funny. I remember hearing there's one VC that told me he liked poker, and he liked it because it was the closest thing that he could think of that came to venture. Meaning, like, you have a set amount of capital, right? And you have a number of hands that you see over time. And at some point, you have to make a decision whether you want to invest in that hand. And as more cards come out, are you willing to invest more capital into winning that pot? And he said it was an interesting comment because something I kind of remember because ultimately that's partly what a lot of investors do, right? You think about on average they're probably seeing anywhere between 1,500 to 2,000 executive summaries or company summaries a year, and they may make one or two investments in that year, and they got to decide is that opportunity that they're seeing the best opportunity that they're going to see that year, and does the risk reward profile make sense for them? And I think as Jen's mentioned, ultimately they're thinking in the back of their head, is this a company that I could see be a 10x? Because by and large, out of say 10 investments in that portfolio, the fund is going to make money off of one or two that will be outliers. Probably half of them will be written down to zero or near zero, and the other three will basically break even or return capital. Yes.
What percentage of VC funds of their total fund do they use during the investment phase? Like, how much do they save for later rounds of financing?
Good question. So it depends. There are some funds that will pool the reserves, and other funds that will try to allocate specific reserves for companies. But in general, you typically see, let's say if a company is if it's gonna take 10 million if that firm's gonna invest 10 million to that company over the life, it'll probably be dependent on the milestone map in terms of what it's going to take to get to an exit. But think about it as pretty much like a quarter. So they'll invest a quarter of that 10 million at that first throw, and then reserve for follow-on funding the other three quarters. But yeah, so that's an interesting question. Great question, because it also, an underlying aspect of that is when you think about going out and talking to a venture fund, highly important to get a sense of when that fund was raised. Well, the year. So if we're in 2016 now. If that investment phase is in the first 3 to 4 years, if you go and you start knocking on the doors of a fund that was raised in 2010 for an early stage investment, the timeline just doesn't make sense, right? And as I think Jen's made the point earlier, or somebody made the point earlier, time is money, right? That if you look at the bottom, the impact on the VC returns in exit time between a 3 and a 5 year, a 5 and an 8 year time frame, it's only a 3-year difference, but it really impacts their IRR. And ultimately, as a fund, they promise their investors, their LPs, a certain return, and in order for them to be successful to raise another fund, they got to be able to demonstrate outsized returns relative to their overall peers. I think some folks touched on this in terms of dilution in ownership for founders, and I won't walk through this, but because I'm sure you can get the slides, but this is just giving you a sense of how after several rounds of funding, what the impact could be on a founder and founder shares. One of the things that I wanted to kind of just talk about here is a lot of times, and we see this more on the tech side. My colleagues see this more on the tech side than we do on the life science side. But kind of a hyper focus on pre-money valuations, and at the end of the day, it's ultimately if you're faced with a term sheet that doesn't give you the valuation, the pre-money valuation that you ultimately are seeking, and that's the only term sheet that's out there, it's just given kind of what's happening overall in the macro environment right now as well, it would just be somewhat, I think, foolish to get stuck on that pre-money valuation and getting being overly focused on the dilution, because especially if you're in therapeutics or even on the device side, there's going to be so many multiple rounds of funding that is going to be required to get to an exitable standpoint that quibbling over some fraction of ownership at the front end is ultimately just really not worth it. You're going to be entering into, when you bring on outside capital, whether it's angel, whether it's venture, you're really entering into a marriage, right? The investment dollars are fungible, but the investors aren't, and you ultimately want to make sure that you have a strong relationship with the investors that you bring on board, and that ultimately starts in the beginning, and the pre-money valuation ultimately doesn't, in the grand scheme of things, doesn't really impact things too much if you can't realize your product and get it to market. So it's one of the things that we constantly have to talk to our entrepreneurs about, and sometimes it's helpful when they can see the data, when we're able to share with them the data from our research that just shows what the pre-money valuation ranges are, just so they have a sense of what market is. And then in terms of, if you get to that point of getting a venture term sheet, a lot of these different features kind of come into play, whether it's tranching. Particularly, we see that more on the therapeutic side than on the device and digital health side. But ultimately, these are one of the ones that are most important in terms of liquidation preferences, participation preferences, which would be important to the entrepreneur. A number of the different law firms put out some great reports that look at the trends in some of those term sheets in terms of the what liquidation preferences are, whether it's turning towards like whether 1x or 2x is kind of market, and they do a really good job of kind of providing that information. So whether it's Cooley, Wilson, DLA, a lot of them put out some good reports on just term sheet trends. And then corporate VCs, I think one of the things that we've seen over the last 7 years has just been a tremendous growth in the number of venture arms that are springing up from corporates. And one of the great benefits of them is that as a single LP, there isn't as much concern about the ability of that fund to be around and being able to kind of do follow-on capital, follow-on investment. But I think certainly one of the things to keep in mind is what are the considerations of that fund? Is it more strategic? Is it more financial? What is really kind of driving some of those decisions for that corporate venture arm? And then also, how have they syndicated with other investors in the past? I'd say probably about 10 years ago, there was a lot of concern from the entrepreneur community that you didn't want to take money from corporates because that would basically send a bad signal to investors or to the market that you're basically locked up. I think that sort of mentality has kind of gone away. We've seen a number of different early stage Series A investments where it's been kind of a syndicate of corporate VCs that have come together. One of my colleagues put together a report recently that over the last 18 months, 35% of all the venture Series A in therapeutics had at least one corporate investor in that syndicate. And this just kind of gives you a sense of from both for biopharma and device, the number of deals that have been done and the total dollars raised and who's been most active. We've tried to keep tabs of this because one of the things that we've seen a challenge for some corporates is that typically in the past what would happen is once a company, an early stage company would get funded by a venture fund and they would do some follow on capital, and at some point when it would get to a point where they wanted to take it around and show it to the corporates, that was a lot of visibility of what was out there that people were seeing. But after the financial crisis of 2008, what ended up happening is that really put a crimp on the ability of some of these venture funds to raise follow-on funds, and they ended up moving towards later stage, and I won't say abandoning, but doing less early stage investing. And so as a result, we began seeing fewer early stage VC-backed companies that were being surfaced to corporates. Now, we've had a couple of corporates that have actually come to us and because of the breadth of our portfolio, have come to us and asked to help surface companies in certain areas of interest that they have. And for us, it's really kind of an opportunity to provide our clients with a potential introduction that could further, validation for what that company is working on, and ultimately, with the eye of ultimately using that validation to help them get that first round of equity funding. So we've done this week. We had Procter and Gamble in, and they had a number of different areas of interest that we were able to surface some companies that had some unique technology that they wouldn't have otherwise seen because they're not venture funded. But hopefully it serves as a point of validation that they can either do a partnership, a co-dev deal, and hopefully move that company down the path of getting market validation for the product, and then ultimately hopefully getting them some VC funding down the road. I find particularly with folks that are either first-time entrepreneurs or that are not as familiar with what we do as an organization on the debt side is really the talking about debt as a potential way to capitalize your company and what the benefits of what the pros and cons are. There are really two primary debt providers, so banks like Silicon Valley Bank that lend money to venture-backed companies. There are also venture debt funds, so very similar to VC firms. They raise some capital from investors to deploy and basically promising them a higher rate of return than they otherwise would be able to get. So as non-regulated entities, they tend to be a little bit willing to take more risk than a bank would, but that trade-off is usually with a higher price in terms of interest and warrant coverage. Things to kind of consider about a potential lender, obviously, is what is that source of capital, and what does that imply for either what you're going to be paying on interest or warrants, and then also what their track record is, and just like any other, even as you're thinking about considering certain investment from a VC, same thing from a lender. You'd like to check in with some clients or entrepreneurs that have worked with them in the past, see what their track record has been, because you certainly want to be able, if you do put a debt facility into place, you want to be able to tap into it when the time's right. And for the most part, a lot of the times where we get involved from a debt perspective is it's got to be into a venture-backed company. So we'll augment the equity capital that a company has raised in order to help that company either finance some capital equipment that they need to purchase, or in some instances provide some cushion to enable them to move further down the road, or serve as almost as an insurance policy in case things take longer to meet certain milestones, so the company doesn't run out of cash before you're able to achieve that milestone. Outside of that, there are, for later stage companies, there's more traditional commercial banking type products like working lines of credit, trade finance. But for the most part, a lot of what people tend to think of us is on the venture debt side with helping kind of finance in between venture rounds for companies. And just like any kind of equity term sheet, there's different aspects to it in terms of the commitment facility, the amount of time. So in most instances, when a company secures some institutional capital, that VC funding is going to provide that company anywhere between 18 to 24 months of runway to achieve those milestones. And our debt structures are typically 3-year debt structures. So at the tail end of that equity dollars running out, the capital, the cash in the bank that the company has really is the debt that the lender has provided, because those tend to be 3-year term loans. And so if you're getting equity financing for 24 months, there really is some risk that the lender's taking on the back end. So part of the reason that we focus on venture-backed companies is that we're really taking financing risk, right? Given a company that is backed by a syndicate of VCs that we know, we're basically taking a chance on what is the likelihood of that company being able to raise some follow-on capital from that syndicate of investors or being able to raise that next round. And so for that, we get paid obviously kind of a premium interest rate to the market, and also get some warrants associated with that. And sometimes those loans come with covenants that either serve as kind of guardrails to make sure that that company is just kind of moving in the direction that was planned, and that things aren't kind of falling off the tracks. So if it's a financial covenant, it's typically kind of a later stage company, but a lot of times it could be in the form of a milestone, particularly if that Series A is tranched. Sometimes we've seen Series A's tranched where it's an announced $15 million Series A, but it's really kind of a 5, 5, and 5. So sometimes we'll structure our debt around those similar types of milestones and structure that debt accordingly. And for that, we do take a blanket lien, and most debt providers will take a blanket lien on all the assets of the company, and sometimes we'll include it IP. A lot of times we can exclude it, but just have a negative pledge on it, which basically means you can't pledge that IP to someone else. And ultimately what the purpose of that is just to make sure that we contain the value of the company, so that in a downside scenario, there's ultimately some value that we can capture there if you have to go into a wind down situation and have to sell the company. But those are things that obviously are made as a joint decision with both the investors and management, because ultimately, if that company's not able to raise more capital, no one's moving forward with it. So a lot of times that's where that reputational risk comes in, and really wanting to know who you're working with and what kind of track record those lenders have with both the VCs and with the entrepreneur community. And as I said, for that risk that lenders are taking on the back end, they get compensated through warrants, which could either be on common shares or preferred shares. And if it's on the preferred shares, it's usually at the last priced round. So one of the things that I always kind of try to stress to entrepreneurs is that when you start fundraising, it's never a one and done thing. You're always constantly fundraising. It's just a continuous process where you're always raising that next round of equity, because it takes a long time. I've had some situations where from initial meeting to funding, it's literally taken 12 months from that first meeting and that introduction that we facilitated to the investor closing on the docs and funding and wiring the funds into the company account can take 12 months, sometimes longer, because it's a process, right? It's as they were saying, you start with that. They evaluate that executive summary. They determine whether this is an idea that a potential company that could be a 10x for them, and that diligence process is a long one. So because of that, you're constantly are fundraising. So once you close that A round, you're already trying to think about who's gonna come in and lead that Series B. And a lot of times you are fundamentally building that network, and you're building that path to the Series B as you're raising the A, as you're socializing the deal, as you're talking about it with other potential investors, and really kind of constantly fundraising. So get used to it. And ultimately, I think one of the things that I like to encourage entrepreneurs is to really think about it from the investor standpoint, right? They are ultimately, you're asking them to invest in your company, and they're basically buying a risk reward profile. So what is, how much is that worth? Ultimately, you will come to some decision, some agreement on what that valuation is. But they're really thinking about, okay, if I put X amount in, what data or what do I get out of it? And in the long term, what is that return going to be to me? For an angel investor, that's going to be slightly different. That's going to be a slightly different point of view than, say, a venture investor, which is really looking at for a 10x type return. And realistically, it's if you can put yourself in that investor's shoes and try to tell that story from their perspective, and how you and your company and what you're building is really going to be able to enable that. I think it just helps put everyone on the same page. And as Jan said, do your homework. A lot of this information can be picked up from sources like Cambridge Associates, VentureSource, CB Insights, Crunchbase. Before it folded, the Funded was a great resource as well. But I would highly encourage you to use your network to talk to other entrepreneurs, folks that are a little further down the path than you in terms of their fundraising and their development of their product. And again, I can't stress it enough. Just valuation is a very subjective topic, and you can come armed with our data, with other data about what pre-money, what other company got, what valuation, and ultimately, if you can't come to an agreement, you're not going to get funded. And you just have to kind of go into it with trying to be able to rationalize and explain why you think you deserve that valuation, and try to support it with comps and other data. But ultimately, it's the golden rule. It's they got the money, and if you want that financing, that's ultimately they're going to drive that decision. But at the same time, it's a two-way street. You have that ability also to select the investor that you're going to be bringing on board, because it's a marriage. You're entering into that relationship, and the separation can be nasty. And so you want to make sure that you make that decision with the right partner at the front end, and ask them, what is that you bring to the table? How can you help my company succeed? What contacts, what relationships can they bring besides the money? Because everybody's money is the same, but the relationships that they bring and the value that they've created and been able to bring to other companies in their portfolio, that's the key difference. And that's where talking to the companies that they funded before in the past is important as well. And with that, if you guys ever have any questions, please feel free to reach out. Email is probably the best way to get a hold of me. But I also, again, highly encourage you to take a look at our website under the Research and Insights tab. There's a lot of reports that we put out. Obviously, we're just trying to share our insights and our knowledge with the entrepreneur community, and really think of us as a resource and a champion for entrepreneurs, because without entrepreneurs and without the investors that fund those companies, we wouldn't have a business. And so we're really thankful to have organizations like One Start that we participate in, and try to find ways that we can help people that are going through this program, because ultimately you guys are the ones that are innovating the next products that are going to make this a better place. So thank you.